Hi, this is Randy Finney with the right side of the chart, and this is a closing market wrap for Thursday, March 26, 2020. Let's get the ugly out of the way. It's not so ugly, but the USO seems to be kind of getting me on the official trades lately, and then the day after, like the last one we did, we had a very small couple percentage point stop. This one was stopped out for a total loss of 4.5, but it was effectively a 3.6% loss because the suggested beta adjusted position size for this trade was zero point 0.8. So you multiply zero point 0.8 or 80% of a 4.5, that's a 3.6% loss. And what they did is they just got our stop right there, a little couple dips below that 468 level, and then rallied back up. Either way, let it go. Do what you want, of course. You might have used a wider stop. I've been keeping stops very tight on this one. A lot of some of these counter trend trades. Now whether it gets there or not will depend on what the market does. So let's talk about that going forward. I did get a post out to you guys. Well, I did a video earlier today, kind of showing you the levels to watch and where I thought we'd probably be going. Upside appears still to be limited. We don't have any sell signals yet, but let's take a look at the indexes. QQQ, we had a perfect tag of that third and final target that's been there for well over a week now. That's T3 right there. So we're on the 30-minute time frame, and let me turn off the pre-market or post-market trades here, and that'll make it look a little clearer. Turn that off right there. Never. All right, so there it is. You can see that's that 172 level. It's been there, and we hit a high today of exactly 192.72, excuse me, and that was exactly the high right there before we pulled back. And remember, that level also came in, although I originally added it before I even looked at the fibs. I told you I do this very often. I'll come out with my price targets, support, resistance levels first. Then I like to add the fibs afterwards, and it never fails to amaze me how often a Fibonacci retracement level. When I say fibs, guys, I'm referring to Fibonacci retracement levels. It's a measure, it's a move. This time I measured from the highs down to the lows, and so that's a 38% retracement, which is a key level. A lot of traders will incorporate fibs into their trading. Some use them exclusively. I like to just help, incorporate it. That's the Fibonacci ratio and sequences. It's almost magical. It's found in nature throughout everything from the rings on a nautilus shell to leaves on a tree and everything else. But it works well in trading. Now look, whether or not you believe that ratio should have any predictive value doesn't matter, because if other traders use it, therefore it comes in, it could be a self-fulfilling prophecy or whatever you want to call it, the fact that traders are using that. But again, more important, I put a much heavier weighting on the resistance level, and that's it. So that doesn't mean we can't go anymore. It was just back here, it was my max bounce target that I could see in the charts with this bullish divergence, everything else, and it's now been hit. So although I didn't make it an active trade before the close, the uptrend is strong. We don't have any signs of reversal, so we'll see what happens tomorrow. I might get if I see an objective entry, even if we push up more. If we push up beyond that, it doesn't mean that all of a sudden, hey, it's not a bear market rally. It's now a much more than that. We're heading to new highs. I mean, a typical retracement of a counter trend move, corrective wave. A corrective wave in a bear market is a bullish wave or a rally. Usually runs anywhere between that 38.2 and the 61.8% Fibonacci retracement level. So there's plenty of upside to go, and there's still key resistance levels all the way up here at about 218.50. But yeah, again, I'm not seeing the fundamentals improve. New York City on a lockdown, everything that's going on there. Like I said, eventually this whole corona mess will start to abate, and one day it'll be behind us. Maybe that is sooner than later, but again, I'm viewing this right now as nothing more than a bear market rally. And as I said, when things look doom and gloom back here, you will want to buy, you'll want to go long. Everything will seem and feel and look bullish. Yeah, somebody posted the stats, I know too, biggest 3-day rally since the Great Depression, 1933 or something. Well, that's also because look at the drop. Look at how this bear market started off, and if you followed me for a while, you've heard me assign one term to this bull market from the 2009 lows to up until the recent highs, and that's supersize. Biggest bull run in history, longest in history, longest economic expansion. Therefore, the corrections and finally the bear markets are going to be supersized in scope. So I'll just show you real quick here on the weekly chart. That's not what I intended to get to, but we rally back right into some pretty significant resistance levels right there on QQQ, that 192.46. I haven't even touched these charts in a while. SPY is coming up. There's a lot of lines on here. It's probably confusing. Let me find a cleaner board for you. Maybe I'll have a line I want to show you here somewhere. I think I have the trend line. Gotta have it on one of these boards. Maybe not. Okay, this one has a lot, but the trend line that I'm looking at there is this one right here, and it comes in. We're about back testing that trend line, and there's some resistance overhead on SPY. Let me show you a daily chart, and we'll get back to those 60-minute charts. All right, this is a pretty big level here on SPY. Remember when we were going down somewhere in here, I added next support zone, minimum bear market target, which still has not been hit in SPY. That was the highs from 2015 through 2016, actually late 2014. But we did hit that level on the Dow. So for all intents and purposes, maybe that's where we get it, because those are key levels, and a lot of buyers stepped in there almost perfectly. Again, that same level on the Dow. So maybe we never get there on SPY. Maybe that's it for the bear market target. I'm open to any and all possibilities. Like I said, to me this feels more like a bear market rally than the end, the beginning of a end of the bear market and the start of a run to new highs. To me, it's again more of a matter of how high we go before the next leg down. And even if it's a correction, by the way, guys, we could, depending on what goes on in the economy and all that, I'm open to the fact that we don't have to just take another major leg down that undercuts the lows and heads down here, but I'm very much open to the possibility of that. For now, I gave you guys targets. Let's go back here on the 60-minute charts. I actually drew them with arrows today on the charts I just posted after the close. At least I think coming back down here, each of these former resistance levels and targets on the way up, like the 250.50, can serve as, because they did act as resistance on the way up, they can serve as support or targets on the way down. But at this point, with what we had, I think if we can start to get a nice reversal, if these divergences can play out right here, then I think we're looking for a pullback to at least this 290, we'll call it a 245-ish level. What would that be? That would mean about a drop of, where we closed today, right around, you can see here it is, 260.93. So when I posted that chart after the close, it must not have showed the final print. Sometimes this charting platform and others they'll adjust the closing target. So we closed at 260.93, which is even closer now to my target of at 260.90. So disregard what I said. We did still hit it to the penny on the highs at QQQ, because that was a high of 192.72, and then we pulled back. So look at that, we popped a little above the 260.90 target to close the day at 260.93. 3 cents on a $260 security is statistically insignificant. It's less than probably 1/10 of 1% there. So and again, the point is that those were key levels based on the scope of the pattern, based on just 1,001 factors. Figured that if we got a nice healthy rally, that'd probably be the end of the run. Cannot rule this one out. What we did is it's a pretty big level, and there's a big gap right there. Like I said, I made my my thoughts pretty clear that I don't favor it, and I think it was enough to go home, not heavy short, but mildly short, and that's why I didn't add it as an official trade. I talked about starting to scale back into swing positions here. What does that mean? Well, you take a partial position, maybe a quarter, a third, no more than a half, and then if we do pop up here, that's another to 273. Let's say we run all the way up there. You can add more there, average down. I like to only average down if I plan to do so ahead. A lot of retail traders, they make the mistake of averaging down on a losing position to to quote unquote lower their cost basis. Technically it does lower your cost basis, but when a trade's working against you, you're building and you're fighting a trend, and you're increasing your losses there by adding more and more to that position. Whereas professional traders will often average up on a trade. In other words, let's say you were bullish bat down here, but there were a lot of risks, so you started buying SPY right here, and it went up. Okay, broke above this little thing. Okay, and you said, all right, I'll wait for a breakout here. Boom, it broke out, and back tested. So that was another objective long entry, like I pointed out at the time. When it took out T1 resistance, maybe add it again. But at this point, again, you don't want to keep adding, at least not in my opinion, unless now you would continue to add if you thought we were going to new highs. And as if and when the charts continue to develop more bullishly and reaffirm the longer term, targets that you had or the likelihood of those. But all right, so it's just going back to that. What I was talking about here is, it's if since I'm not, very, very confident or highly confident this is the end of the run, that leaves that, what did I just measure out for you? About roughly a potential of another 5 or so, a little less than 5% upside. And so, you could, if we happen to get up there near that level, then add to your position. And if you're scaling into, what it means is maybe tomorrow we start moving down, and that then we have a rejection there, because like I said, right now we don't have any sell signals. And I short in one of two ways. Typically, I'll either short a breakdown of a bearish chart pattern. Let's say you have a bearish rising wedge, stocks are moving up like this, and then your sell signals right here on the breakdown. Or break of a horizontal support level, stock is bouncing on support, expect a break, so your short entry is below. That's one objective way to add to a short. The other objective way is this right here. Instead of shorting a break of support in a downtrend, or whether it's an uptrend you think is going to end, you short a rally into resistance. Because if you want to keep it tight, let's say you don't want to scale down, let's say you want to add a full position, you can just simply put your stop somewhat above there. If they take it out tomorrow, remember there's always opening order imbalances tend to get resolved pretty quickly. I usually like to wait and see if there's a gap up in the morning, give it a half an hour, sometimes 45 minutes or an hour, to see if that initial pop is faded or built upon. But anyways, those are, I guess, in a lot of ways to skin a cat, as the old expression goes, and there's a lot of ways to trade stocks, or if you're looking to get short here, all in position, or not all in, not in your full account, but a full position in that, partial position, which you give it a little more room, or wait to see a reversal, some kind of sell signal. What would that look like? Well, maybe a big bearish candle, big gap down tomorrow, rejection off that level, break of the next support around 2051 or 2050, wherever. All right, so that's that. I don't want to beat a dead horse here. Negative divergences, everything else I covered earlier today. Negative divergence on QQQ, rally into resistance, same target, similar targets. At minimum, pull back to here about 185.50. Right there, be your first target tomorrow. I'll try to quantify it, measure it out for you in a second here. 185.50 with a likely target down here to 179.13. Remember, that's where we started the day today, right there. Remember that in pre-market. It's not shown on here because I've turned the pre-market trades off. So that was a nice move off today's lows. The market with QQQ was at support, and from there it rallied, almost 8% today off the lows. You're only seeing a 5.25% gain because we were down. We were poised to gap down, but that support level held, and the GDP report turned everything around. So you got, durable goods. Now I should mention, I'm talking fast here, so many things going on in the market now. GDP is tomorrow, but GDP, even more so than durable goods, which came out today, is a very hindsight report. GDP is reported quarterly, gross domestic product, and so it's lagged. It takes, when the quarter's over, it's still almost a month before the numbers come out. So you're looking at data that's up to 4 months old, and then even then, it's usually revised in hindsight. Just about every recession that I can ever recall, the GDP figures were revised downward well after the fact. So all I'm trying to tell you is, take, just like today's durable goods report, which it came in at the high end of expectations, high end of the range. Same thing. Don't take tomorrow's GDP report with a big grain of salt if it comes out more bullish than expected, because I think it's going to be revised downwards, and I'm sure it's already been revised downward, the estimates. But again, I just wouldn't put too much into it. This is an unprecedented situation right now with what's going on in the economy because of coronavirus, and the economists are playing a massive guessing game as to what impact it's going to have fundamentally on the economy. So right now, I feel more confident using the technicals and trying to figure out, trading off the GDP report or durable goods or anything like that. So there it is, small little divergent high, potential divergence, PPO's pointing up, maybe it burns through, maybe not, but like I said, I think objective level. And how you trade it's up to you. If you want to cover on those, if when we hit those targets, it would be a nice drop if we got back down to either of those, even just the first target tomorrow. You could short QQQ or buy SQQQ or QID or PSQ. Those are all 1, 2, and 3 times short ETFs. You can buy them in the after-hour session, and it's about almost a 4% drop back down to that 85. 50-ish level, and it would be about a 7% drop or so down to that 179 level, and that's that could be a quick swing trade. I'm sure nobody's going to complain about those type of profits, and if it happens, I think it'll happen pretty quick. And then the other way is just if you happen to get a hold of one, let's just say this is just the first big bear market rally. This was some little counter trend bounce, and this one was much larger. Let's say it is the first one in the next wave down to come in the bear market. In that case, you can just trail stops down instead of booking profits there. As you hit these levels, probably get reactions along the way. Keep a wide stop and allow for the potential for a big runner trade where you're going for maybe 20% or more downside in QQQ. Certainly a possibility right now. Just really hard to say that with the highest degree of confidence. We'll have to see how much of that short interest and excessive put buying and everything else was cleared out in today's move. I have little doubt that there was a good deal of shorts being squeezed out today, and that's actually a good thing if you want to short. You want to be the lone wolf when you're shorting. You don't want a lot of company, because if everyone else is short the market, that's going to put a floor in how far down it can go, and that's again why we couldn't go any lower, because there was too much bearishness here recently, too much put buying, too much short selling, and all that good stuff. All right, so that's it. IWM, I want to talk on that. Never made it all the way up to that third target yet. Wrote up that what I call benefit of the doubt trend line. Remember, I had one right here earlier, and that one broke, and then it hit this secondary one. I think I covered that in the video earlier. So a little shy of that third target. If one scenario, maybe we pop in the morning, maybe we gap up. QQQ and SPY would probably have to gap up above those levels. I doubt IWM would come all the way up here. Maybe it's a gap and fade where they gap up and down. So, if you are long IWM holding out for more, there's nothing wrong with that. Keep a stop here. Just keep in mind that this market tends to gap, and you have just a likely as much, and I think in my opinion more greater chance tonight of gapping down below that trend line. And you can see some of the targets there on the way down. A nice swing target would be back down to that 108 level right there on IWM if it were to get there, and that would be good for about a 7% or so drop as well. All right, so I covered oil. Yeah, I covered that. I'll post an update, and I'll move it out. I started last week to work on all the long trades. There's still quite a few old trades that are listed as active trades. But as always, when you go into those trades on the site, and I'm talking about the trade ideas here, I'll get to that in a second. You just want to look at the notes on each of those trades, and I'll tell you if I haven't extended a target or changed the stops, and it hit either the maximum stop or the final target, that trade should be completed. Sometimes it's just a matter of me getting around to making a final post, calculating what the gain or loss was on the trade, given any final thoughts, and then I move that out to the completed trade archive. So some of those trades are still stale or closed out in the long trades. I think all our short trades are up to date right now. And I did post this earlier today on that USO trade right after posting, as well as in the trading room. I said it was a sort of a anticipatory trade that we would break out, and we went long at the trend line on USO, but crude futures had been bouncing above bouncing on this downtrend line, and had that 2405 level, and said we need to take that trend line out and then 2405, and we never did. So that's where crude just continued lower today. That was, again, I was just trying to get in front of that one because I figured if we broke it, especially with the stock market rallying so hard today, I think we would have had an explosive rally, but it went the other way. They never broke that support. And here, let me cover that for you. CL, no, that's cocoa. I didn't mean to pull that, but just so you can look, cocoa futures, little back test of the trend line there. Let me update that chart. Yeah, same, it was updated. There was that uptrend line breakdown and back test. So I did the video on the a lot of commodities the other day, but there is some price support there. I really wasn't intending to get this one. When I look down on my on the bottom of my screen, my taskbar, I have all the futures kind of truncated. I have a little C for CL, and then dot dot dot, and then I have a C for CC, which are cocoa futures, which we're just at. So this is a chart I was trying to pull, and it's still a setup. Look, if the market continues to rally, if I'm wrong that this might be the end of the run, at least near term, before a correction in the stock market. If stock market goes up, remember in the video today I said that we broke that support, but look, we closed right back on it. So far a potential bear trap. See, we dropped below it, snap back up, and I believe I talked about that earlier today, and I also said we can go down as long as it's a relatively brief breakdown and give us this little wedge type pattern. So the same thing holds true. If this can break, and it's really going to help. It's not 100% necessary, but it will help to see the stock market rally for a nice rally, a sustained rally in crude oil. And those are still the same targets for CL crude futures. If the trend line breakout occurs 24, 22-ish, give or take, then $25, and then who knows? Probably it. I would certainly. That's big resistance. So if you can get a quick pop up to 25 from here, that'd be a nice move in CL. Probably a good place to book profits, or at least trail stops if you want to let it ride. Well, we're virtually unchanged on our LQD trade. It was a little positive as well. Red LQD was down earlier, meaning we're positive on the trade, but we're back to about where we started. No big deal. And I did an update earlier. I still very much like this one. As a longer-term swing trade. We just may have to give it a little more room right now. May take a little longer to play out. Maybe not. A lot of this recovery has just been the Fed injecting money in. The Fed knows what's going on here, very much so. And they're but again, I'm pricing in how much of the Fed rescue plan, stimulus package coming in, trying to prop up the credit markets, how much of that 17% recovery or so, right up to that 61.8% Fibonacci retracement, see right here, and that 123.30 level, how much of that's already priced in. So I feel good about this trade, but like any trade, it's just one. You don't put all your money in any one trade. It's one of many, part of a little piece of the pie. Gold, we're still long and strong gold. It's did I hit what, I might have missed that. I didn't have a price target alert. Do I have it set? Yeah, oh no, we missed it. We didn't hit our target. We just missed it. High of 155.66 there the other day. And T3 is at 156.10. And I told you guys, and I do mean to do this, I would most likely extend additional targets. Let me just say this now. That's my plan, is kind of just hold on, allow this to be a runner trade. That's still the third target. Still an objective level to book profits. We came close enough the other day that might effectively, if for all intents and purposes, that might do the trick, but I still like gold, and that's why I wanted to update it here. So, we early on, we hit our first and second targets right after the day after we entered that trade back here this day with that big red candle above that 136.37 support, and it's looking good. For all the reasons I mentioned before, I believe gold to be in a bull market, and I have for a long time. And when you get a correction like that, pull back to support, those are the kind of opportunities I like to buy and go long. So, and the other thing I like about gold is the dollar. I talked extensively about the U.S. dollar, shared my thoughts on it. I think the dollar is, at a major, most likely a major top. The charts reflect it. I think the fundamentals reflect it. It's going to cost the U.S. a lot of money to pay for this stimulus package, and it's not going to be a good thing, I don't think, for the dollar long term. I know a lot of other countries are in, their fiscal house is not in good order either, and currencies are all about, right now, who's the best of the worst. But again, the charts are reflective, and I like to use that euro-US dollar pair. Paints a pretty clear picture. And you can see this big divergent low and price channel right here. So when I zoom in, we already had one breakout, proved to be a false breakout, and that whole thing was due to a shortage of dollars. There was the credit markets were about to break there. Again, I think I posted an article or at least a link where you can read up about that. That was what was going on recently. So it caused a big surge in the dollar, which brought the euro back down, but it didn't change the technical posture. Just put in another divergent low, extended the existing divergences. So why am I talking about this? Because we're not trading currencies. We're not long the euro or short the dollar. All about gold. If you're new to the site, I go over the relationship all the time. It is an unmistakable relationship, an inverse relationship. When over time, the bigger trends, when the dollar is falling, gold is almost always rising, and vice versa. There are periods where it disconnects. We've seen one of those periods over the last year or so, but go back for decades and you'll see that relationship, simply because a falling dollar is bullish for gold because it takes more dollars to buy an ounce of gold, and when the dollar is strong, it takes fewer dollars to buy an ounce of gold. So just wanted to do an update on the gold trade, and so far so good. Still watching. I'd like to see that high. I'd like to see these divergences get burned through. Not crazy about these, but I already addressed those, and they did play out so far for a drop of 15%. So the question is that enough to satisfy those negative divergences?